Let's talk about student loans. This comes up in our industry daily. And really, what the issue is that student loans affect you differently depending on the status of your student loan and the loan type that you're doing. Um, I really want to go deep on this topic because it is a big issue for a lot of people. Um, Student loans don't automatically stop you from buying a home, but they can affect how you buy a home. They can affect what you can afford. They can affect what type of loan that you can do and what loan is best for you. Just because you're not paying on your student loans, or they're in deferment, or you think they're going to be forgiven after you finish working for this company or this place or a system for the next few years, if they're on your credit report, they still affect you. So that's the biggest thing. If the student loans are still on your credit report, they still affect you, and they still have to be taken into account when it comes to determining what you can afford when it comes to your mortgage loan. So this is how underwriting typically treats student loans. FHA is often the most flexible. FHA loans, if you're in repayment, we're going to actually take the payment that's on your credit report. So if you're in repayment, that payment is going to be taken and counted against your DTI. If your loan is in deferment or your loan is in forbearance, then we got to use 5% of the total loan balance for a qualifying payment. So again, that's 5%, 0.5%, I'm sorry, of the total loan balance as your qualifying payment. So even if that payment is paused, FHA still counts a payment towards your debt to income ratio. So when you go in and you're basically taking a 0.5%, so if you got $100,000 worth of student loans, we automatically got to count, we have to count $500 against your debt to income ratio right there. So it doesn't matter that you're still in school or that those are going to be forgiven sooner or later because of your job and everything, or you're in the military, or in your military is different. We'll go over that later. But 0.5% of your outstanding student loans have to be counted towards your debt to income ratio. So I want you to get your head around that. So it isn't just, I'm not paying those. Just because you're not expending money monthly on that does not mean it's not hurting you, or it's not counting against what you can afford. So conventional loans, that's Fannie Mae or Freddie Mac. The rules are a little different here. If the payment shows on your credit report, again, we use that actual payment. If the loan shows as a zero payment or is deferred, same as a FHA, the lenders, we're going to use 0.5%, 0.5, or up to 1% of the balance, depending on the loan file. So depending on how strong your loan is, and what type of loans they are, if they're government endorsed or back loans, or if they're private student loans, it's going to depend on what percentage, whether you count the 0.5, 0.5%, or 1% of the outstanding balance. Income driven repayment plans can help in both cases, because a lot of times your income driven repayment plan will be less than the 0.5%, and definitely less than the 1% of the outstanding balance that a lender has to count against your debt to income ratio. So it's very important that you, when you look at that option, when you're thinking about applying for a home, you may want to go ahead and get into an income based repayment plan. You could call your student loan servicer. You don't have to actually go do it and just say, hey, what would my payment options be? If just keep that $100,000 worth of student loans, and a lot of people have more. If your income based plan is going to be $150 a month versus $500 a month, and you're not paying it, I think you would rather pay that $150 a month so you could afford more home. That's going to give you at least right there probably about $50,000 to $60,000 worth of affordability where rates are today. VA loans, it's a little bit more flexible. Our VA loans for veterans, if the payment is active, then the actual student loan payment is used. If the payment is deferred for at least 12 months after closing, so not 12 months from the time that you apply, but 12 months after closing, we don't have to count it at all. Otherwise, lenders usually use 5% of the balance divided by 12 months. So if it's something and it's just a status out there and you're not in deferment or whatever, then that they're going to take 5% of the balance divided by 12 months, which again would be better for you to probably get into an income-based repayment plan, versus just letting it sit out there and just worrying about it later, especially if you're trying to buy a home now. USDA loans, they look similar to FHA in most cases. How the underwriter is going to count it, we're going to look at the actual payment that's showing on your credit report. So that payment will be used. If you're paying $50 a month, that's what we're going to use. $75 a month, that's what we're going to use. If the payment is zero, or it's a deferred payment, like you're like, I'm still in school, or they deferred those to 2028, doesn't matter. Typically, we're going to use the 0.5% of the loan balance. So again, If it's 100,000, it's going to be 500 against your debt to income ratio. If it's 200,000, it's going to be $1,000 against your debt to income ratio before you even count any other debts, such as your car note, your credit card payments, your furniture bill, or like you finance furniture or anything like that. So that's where it comes in. So that's what hurts people a lot, because they think, oh, I thought I was going to afford more, because you're physically not making a payment to the student loan servicer, but it is being counted against your debt. It's like silent debt, because it's there lurking, and it's when you want to go buy something, it's there. So we have to account for it, because it's going to have to be taken care of sooner or later. So what this really means for buyers is being on an income based repayment plan can help. It's probably better in most cases. So I would check out your options with your loan servicer. Deferred does not mean ignored. If it's deferred, you may be ignoring it, and your monthly cash flow may be ignoring it, but lenders aren't ignoring it. We know this debt is out there, and that's going to become payable. We can't assume that you're going to be in school for another 5 years and you don't have to pay it. So we have to count a 0.5% or percent based on the loan program. Your loan type can drastically change how much home you qualify for. So FHA is more forgivable than conventional. USDA is equivalent to FHA. VA is the most flexible if it is actually in deferment, because if it's deferred for 12 months past your close date, then we don't have to count into your debt to income ratio. Student loans don't have to make the home buying process impossible, but it does require a plan. So you would need to get pre-qualified, see how much debt we're counting against you monthly against your DTI, to see if you can still afford what you want to afford with us using that debt as it is in your deferred status or forbearance status. And then also what your options are for income-based payment plan, if you start paying on those, and what that payment plan would be and what you can afford. So it's something you definitely want to do some research about, get with your lender about, and then a loan servicer. We do have companies that we're associated with that can kind of help you navigate that. But if you have questions, message me student loans or shoot me an email student loans. Call me 404-461-3172 or apply at reggieloans.com. Hope this helps. Bye.